This egg company just got cut in half, and I'm running to buy more shares every chance I can get. And no, this company isn't a falling knife, but if you stay tuned, I'll give you my bear, base, and bull case where I think this company can easily 2x by the end of this year. What's up, everybody? I'm Darren, aka Cash Moolah. I'm a certified public accountant. I run my own company, and I'm a retail investor. And the views you hear on this channel are for entertainment and educational purposes. I'm not a financial advisor. Always do your due diligence. And for that, let's get into it. That company is, and pull that up, Vital Farms. You may have seen this at your local grocery store, Walmart, or Whole Foods. They're the ones with the happy chickens on the box. This company just reported earnings about a week ago, and the stock got absolutely demolished. It was down 20% after missing guidance on earnings, and it's down over 50% in the last 6 months. Wall Street is totally panicked, but I've been doing my homework. And I think this might be one of the most interesting setups I have seen in a while. I just want to let you know that I do own this stock. I'm going to tell you exactly why. I'm also going to tell you what I think can go wrong and where I think this stock goes from here. Vital Farms is not just an egg company. It's a premium ethical food brand that happens to sell eggs and butter. Their core pitch is that the hens that lay the eggs live on a pasture. It's about 108 square foot per bird. And they run essentially a decentralized network of small family farms versus your conventional egg maker or egg farm where all the chickens are essentially cramped up and never see the light of day. Vital Farms is over in 24,000 stores nationwide in Whole Foods and Walmart. And this is no longer a niche brand. The company was founded in 2007 and it IPO'd in 2020. And it's now approaching $1 billion of annual revenue. So let me show you essentially a comparison of what the consumer would pay for a Vital Eggs carton of eggs versus a generic brand of eggs. Essentially, the generic dozen of eggs is about $3, where the dozen of Vital Farms eggs is about $8. And if you think about it, sales have been growing. There is a consumer base that is willing to pay 2 to 3 times more for eggs, and it hasn't stopped. The company has been growing for about 20, it's been growing 20 to 25% per year. And at this point, you can't say it's luck, it's brand power. So why is Vital Farms stock down over 50% since its peak 6 months ago? There's 3 main reasons. One, let's just get the first elephant out of the room, which is this whole greenwashing controversy about, there was a viral video on Instagram that claimed, Vital Farms eggs aren't as natural as marketed, and they have a high concentration of linoleic acid from corn and soy feed, and that they artificially color their yolks. I'm not going to lie. I saw this, and as a Vital Farms consumer myself, I was at first like, yeah, this sucks. I'm going to try other brands. But as I, started buying eggs, I didn't notice a difference. And so anyhow, look, social media went nuts. There were boycotts. The stock wobbled. But here's the thing. Vital Farms literally disclosed that they feed their chickens with soy and corn feed. And you see it on their website. They've never lied. And essentially, when you're a premium ethical brand like Vital Farms, your consumer base is always going to expect perfection. Anyhow, analysts from TD Cowen called the backlash highly unwarranted and it was misleading. And essentially, the stock ended up bouncing 11% that day that report came out from TD Cowen. But here's the big reason why the company is down and down 20% just recently. Essentially, they missed on Q4 earnings. They reported EPS of 35 cents when they were guided at 39 cents, which is a small miss. But the real gut punch was their 2026 EBITDA guidance of 110 million was versus Wall Street was expecting 133 million. And when you miss forward guidance by 23 million, analysts are going to make you pay. And so essentially there was an institutional sell-off. that saw the stock go down 20%. But here we are. The company, as of today, I'm recording this video, it's March 3rd. The company is at about $20.30 a share. But here's the third strike on Vital Farms. And it's this whole, macro environment. Right now we're currently in a conflict with Iran and the Middle East. There could be some headwinds with rising costs. It could pinch the consumer. But if you really think about Vital Farms is consumer based, if they were already paying $8 for eggs, I don't see that much really changing. However, if there is a big layoff in white collar jobs, that is something to monitor, because I would imagine a lot of the consumers that buy Vital Farms eggs are on the top end of that K-shaped recovery. So, and, management, they did flag that there's, volatile scanner data in January and February. And so they did see some softness with the whole social media backlash. So to sum it up, when you got a viral controversy that's against you, you miss on guidance, you get a downgrade from Wall Street analysts, and you're facing macro headwinds, all that hitting you at the same time is why you're going to find your stock down 50% in the last 6 months. But here's why I think this is totally overblown. The financials are actually pretty strong. Full year revenue ended up coming in at $759 million, which is up 25% from the prior year. EBITDA hit a threshold for the first time ever. They hit $114 million. The company on their balance sheet has virtually zero debt, and they have about $113 million in the bank. And they just authorized a $100 million share buyback. And this is the first time they have done that since they've gone public. Essentially, management who is authorizing a share buyback at this time is essentially signaling to shareholders that they think this current price is not warranted, and it's a good time to buy the stock at this price and increase shareholder value. So they think it's cheap. So another thing about margin compression, which is another reason why they've gotten hit. So their EBITDA guide dropped from 15% margin to 12%. And that's really what spooked analysts. But management was explicit. They're taking the pricing gains from a May 2025 price increase and reinvesting that into promotional spend to convert brand awareness into new households. They're not essentially losing pricing power. They're just choosing to grow the customer base. And that is a totally different story. Brand awareness is up 34%, which is up 8 points versus the previous year. And that's a massive gap between people who know the brand and people who actually buy it. And essentially promotions close that gap. So the category tailwinds are massive. And I want to highlight this chart. The broad CPG category is about 4.2%. The organic U.S. food CAGR is about 7.2%, and organic food globally is about 11.2%. Specialty eggs, that whole market is about 12.5% CAGR. And Vital Farms, as they've been guiding, is at 21%. I mean, essentially, they are the number one brand in pasture-raised eggs. And the way that they're growing out this category compared to broad CPG category, it really does look like they will be able to hit $2 billion of revenue by 2030. This is a fast-growing category. So at today's price, the stock is trading at about half times its own 2030 revenue target. So you're essentially betting that a company with a 25% CAGR, zero debt, and the number one brand in its category is worth less than half of what it says it'll do in revenue in 4 years. That seems wrong to me in a good way. Now, I don't want to act like this permabull, so I want to talk about what could go wrong. Well, the consumer trade down is real. If we still face macroeconomic headwinds, not specifically from the war, but more so with massive white collar job loss, meaning the economy gets worse, premium eggs are luxury. And so that is something to monitor, because why would people, spend $8+ for a dozen of eggs when they can get conventional eggs for about $3, right? So it's something to monitor with the top end of the market. Another thing, And this is a scary thing, that margin compression could be permanent. What if their promotions don't work? What if the 12% profit margin is the new ceiling and not a trough? That does change the whole valuation story. And there's also execution risk on the Vital Crossroads, which is a new processing centralized plant in Indiana. They're expected to spend anywhere from 140 to 150 million in CapEx this year. And if construction delays or overruns hit, and that could affect the balance sheet. Another thing, which is not as much of a big deal, but it's something I should address, is that their leadership concentration. So the founder of Vital Farms just stepped back, and the CEO is now also the executive chairman, which does give a lot of concentration to one person. So that is something, but I don't want to overblow it and say that is like a really bad thing. But again, something, leadership concentration is a risk. And going back to this whole greenwashing story, it isn't fully dead. Social media waves couldn't happen, right? There could be a second viral moment where people are still bashing the brand, and this could negatively affect the company and sales short term. So I want to own up to the bear case, because none of these are make believe, they're real. And the question is whether the price already accounts for them. And I think it does. I really think it does. So where does the stock go from here? I'm going to talk about the bear case, the base case, and the bull case. Well, let's start with the bear case. So the bear case is about a 30% drop from today's current price, which again is about $20.30. And bear case, we're looking at about $14 to $16 per share. Now, the bear case just doesn't happen after one bad quarterly earnings. This is like structural. This is something that will happen over the course of like 2-3 earnings, right? So it's just multiple guidance, multiple misses, guidance dropping, EBITDA falling below 100 million, and they're multiple compressing to 7 to 8x. In this scenario, this is where my thesis starts to go wrong. And if this does play out, you will definitely hear from it, because I will pull out of this company if this does happen. But I don't really think that's going to happen. I put that bear case at about a 20% or less chance of happening. Now, my base case, and this is kind of like, I don't want to call it a sure bet, but this is the scenario where, company hits on guidance, Q1 earnings come in line, the market accepts the EBITDA compression as a trough and re-rates the company. The multiple expands from 8 times earnings today back to 12 to 13 times on EBITDA. And, this is just the company just executing like they said they were going to do. And in this base case, we're looking at about $28 to $34 a share, which is, about a good 50% increase from today's prices. And the probability of this happening is, I would say, at least 50% in my view, in my probability. And now the bull case. The bull case is when promotions work faster than expected, household penetration accelerates, EBITDA margins start to recover towards 15%. So they go back from 12 back towards 15. And you can see that accelerating quarter over quarter. The multiple starts to expand back towards the historical norms of 16 to 18x. Revenue hits or exceeds guidance. And this is basically where the stock is just getting back to where analysts had it before its most recent earnings. And I put this bull case where this company would be closer to $42 to $52 per share in the next 12 months. And with my bull case, there's about a 30% chance of this happening. So probability weighted, when you factor all this, I get to about $32 a share for this company, which at today's prices, that's already a 50% upside. Now, again, I know there's the whole macro headwinds, and it's not the war that I'm really worried about when it comes to the macro. It's more towards a lot of white collar job loss. I think that's something to keep an eye on. But the most important thing to really keep an eye on is Q1 earnings. So Vital Farms will report Q1 May 7th, and that will be the first real test to my thesis. If revenue and EBITDA comes in line and management holds guidance, I think the narrative on this company shifts very fast. And again, at the sub $21 price for Vital Farms, I think the risk reward makes a lot of sense to me. Again, the downside to my bear case is about right under 20%. And the upside to my base case, is about 50 to 60%. And so that's the setup I want. So Vital Farms, it's a great brand in a fast growing category. The stock has been cut in half on temporary headwinds. Again, look, I'm not saying that this is a sure thing and no stock is, but when the market throws out a premium brand with 20% CAGR and zero debt at 8x EBITDA because of a viral egg video and recently missed guidance, that's something I want to pay attention to. Again, mark your calendar for Q1 earnings. That's May 7th. And that's when my thesis will get put to the test. And again, I just want to disclaim that this is not financial advice. I do own the stock. I do intend to add some more positions. But at the end of the day, you should do your own research. If you want to see me do a full deep dive on the valuation model and the comparable companies, let me know in the comments. And if you found this useful about Vital Farms, subscribe and like this video. I do breakdowns like this every week. All right, everybody, I will catch you on the next one.